Guarantor loans are designed for individuals with poor or limited credit history who are often denied by mainstream banks. The core feature is the requirement of a cosigner or guarantor, typically a friend or family member with a strong credit history. This guarantor agrees to take over the loan repayments if the borrower defaults. The presence of a guarantor significantly lowers the risk for the lender. Amigo Loans' unique position. Before ceasing new lending and entering a wind-down process, Amigo Loans was the most prominent provider in the UK guarantor loan market. Their business model focused on what they called mid-cost credit, positioning their loans as a better alternative to high-cost payday loans. Key differences in the market. Market share and scale. Amigo was the dominant player, holding an estimated market share of around 85% at its peak. Other lenders existed, but operated on a smaller scale. Loan amounts and terms. Amigo typically offered loans in the range of 2 or 3 payment terms stretching from 2 months. Competitors generally offered similar ranges, but Amigo's scale allowed it to handle larger volumes. Interest rates. APR. Amigo's fixed representative annual percentage rate, APR, was famously. While this is significantly higher than a standard personal loan from a bank, it was lower than the rates associated with very short-term, high-cost credit products like payday loans. Other guarantor lenders generally offered rates within a similar mid-cost bracket, often ranging from to APR. Guarantor criteria. All guarantor lenders require a financially stable guarantor with good credit. Amigo was known for relying heavily on the strength of the guarantor's profile. Some competitors also considered if the guarantor was a homeowner as a positive factor, which was not always a strict requirement, but could influence the loan rate. Customer experience and ethos. Amigo's original ethos emphasized transparency, flexibility with no early repayment fees, and a no surprises ever commitment, which aimed to set them apart. However, later regulatory scrutiny revealed issues with their affordability checks, leading to a significant volume of complaints regarding unaffordable lending to both borrowers and guarantors. The current landscape. Amigo Loans stopped offering new loans in and began a solvent wind-down of its business due to an inability to secure the necessary capital to continue operations while managing an influx of customer complaints and compensation claims. In the post-Amigo market, other lenders who previously offered guarantor loans have either shifted their business model or continue to operate with a strong focus on direct, unsecured loans that do not require a guarantor, like flexible lines of credit. This shift is partly a response to the increased regulatory focus on guarantor lending and affordability. For instance, some current alternatives offer unsecured loans up to without a guarantor, instead focusing on the borrower's income and expenses alongside their credit history.